Hi, everyone. Um, so, Dhiren is many things to the mutual fund industry and to the personal finance space in India. Not many of you might know that he started working way back in the early 90s, if I remember correctly. That's when, yep, that's when he was actually clipping data from Economic Times to create what is now Value Research, to create what I think today is the best website on mutual funds, where you can get data on mutual funds, you can upload your portfolio. Incidentally, Dhiren was also my first boss. He gave me my first break in this industry, and I consider him my guru to this day. So, Dhiren is going to shed some light on the big debates in mutual funds, the questions that I get the most frequently, and the answers that I give are usually the answers that I would have learned from him many years ago. So, without any further ado, the first question that we're going to address is the one on sector and thematic funds. Okay, let's have a show of hands. How many of you have invested in thematic funds over the past year? You would have seen those launches, right? EV fund, consumption, lots of hands going up. Yep. So now we're going to hear Dhiren's take on, should you be doing that or should you be investing in diversified funds?
The rationale for investing in mutual fund is to be able to diversify with convenience, with ease, and instantaneously. And when you choose you decide to go for a sector fund, you are buying into a story, you listen to something, you are basically paying the full price and taking limited service. That's one way of looking at it. It can well be, it can be a supplementary investment for some people. But the whole idea for masses, for whom mutual fund was invented, is to keep it simple. And the whole idea, the reason why mutual funds were invented was to keep it simple, to be able to diversify with convenience, with ease, and with small ticket size. And so in that sense, it cannot be, at best, if at all you buy into the story, then the other thing is that it should be looked upon as a spice, not the main course. The second is that, you have to buy into the story because there is a problem with the sector fund and the thematic fund. That most of the time, these are launched at a time which is very inappropriate. When the story has really got on and it's easy to sell, the story makes sense, you are able to strike a chord with the consumer. At the end of it, mutual fund is a consumer product. And when you weave a story around it, the story should be very compelling. You are able to tempt somebody to buy into it. And that is normally a very inopportune time to invest. So that's why it is generally avoidable. And if at all you do, there are situations, there are contexts, somebody who bought into a technology fund in 1998 was actually a visionary, or he has to get into it. If you were buying just because there was a momentum, then it will be very difficult for you to withstand the decline of year 2000. But if you are really bought into it with an understanding that, okay, this is the emergence of Infosys, and here is the whole sector which did not exist, has come into being, and it will really become big, then it's a different story. So if you buy a sector fund, then might as well start investing in stocks. So you have to really be buying it with belief and understanding and conviction.
Yeah. So basically the core has to be in diversified funds.
Absolutely, for most people, and actually it does the job. Nothing prevents a diversified fund to emphasize something which is more contextual or performing, or the outlook is brighter. But nothing can actually enable a sectoral fund to be diversified. So.
The second interesting thing that's come up post the budget is what to do about debt funds, right? Because debt funds are taxed at slab rate, bonds are taxed at slab rate. It takes a big bite out of one's returns. Now, whenever there's a tax problem, there's always a financial engineering solution. And the solution in this case, potentially, is hybrid funds. Hybrid funds that have a lot of debt in them, so much so that they are almost debt funds. They're as close to debt as you can possibly get. So Dhiren, is that in your eyes a good solution?
Yeah, there are two reasons why people should have debt. One is what was being talked in the previous session, that there's a part of your money which you don't want to take chances with. And, debt can be risky, but, risky of to what extent? It can go down in value to an extent. So that's a different allocation. But generally speaking, if you want to have debt to generally reduce the scale of volatility, you don't want to see your whole portfolio crumble. That's why you should have. And this aggressive hybrid fund, I've thought that, it is very useful for so many people, which people don't embrace as such. Because what happens is here is 25% allocation to equity. Your equity tax treatment becomes debt, but equity, the debt allocation also gets treated as equity. It's beneficial, 12.5%. But there is one thing, which I would like to just point out, that when you invest in a mutual fund, there is one advantage which goes unnoticed. Your long-term fixed income allocation is tax deferred. You are not liable to pay taxes till you take it out. But if you put your money in bank, the interest that you earn or accrues is taxable. So in that sense, that arbitrage still remains simply because of the design of the mutual fund. But keeping that aside, if you want to have greater stability of your portfolio, you don't want to lose your sleep, you are a first timer, or you are approaching retirement, you want to generally become a little more conservative, you saw a decline of a kind which makes you uncomfortable, go for that. And that is a tax efficient vehicle.
My final question to Dhiren, and then we're going to open it up. As I said, if this session is for you guys, not so much for us. So my final question is, Dhiren, we talk about track record a lot. That, go by the track record of the mutual fund. That's the kind of mutual fund you should be buying. But what exactly is track record? What time period do you define it on?
For me, the track record, we are in the business of looking at mutual funds and looking at it closely. Who is likely to replicate, what is going to be, when we look at track record, it is not past performance. That, one should always remember the disclaimer that comes along, that it won't be repeated, and be careful about that. But more importantly, when we look at, from an analytical standpoint, we look at track record, we look at a full market cycle at least, a down cycle, and a great fund is the one which actually falls a little less, rises reasonably okay, and then that is followed by, that is the numbers bit, the risk-adjusted performance which drives our rating system. And so that is a quantitative bit, and on a 3-year, 5-year period, you are normally faced with a situation that there could be a declining phase, there will be a rising phase, and how this fund has been able to withstand or been able to do over this time period. But there is something, the qualitative thing, that what is driving this performance? What is the thinking behind it? Is it random? Is it accident? Or is it a deliberate strategy? Because there are times when, funds will struggle. In a bad market, any fund will struggle. But is there a thinking behind it? Is the fund manager able to, stick around to a process? And style purity, which matters so much, it matters little less now because of the classification system. That's the design of the mutual fund has undergone a change, because earlier it was all, most funds, they sought capital appreciation, and most funds, the objective was go anywhere. Now they have been much more finely, classified, and they're focused on that. But somebody who is able to stick around, because most components of the market are cyclical. So if the fund manager changes with the time very rapidly, you will always be, falling behind. You'll be trying to catch something which has lost its relevance, or maybe. So somebody who has a thought process and is able to follow up, stick around, and changes his mind, but for a reason, and being able to validate that and build some belief, able to judge meaningfully in terms of is it a sustainable one, and meeting that person, talking to that person, understanding what is the thought process, and is a more trustable thing.
All right, fantastic. Maybe just one or two questions. Please raise your hands. Let's try and go at the back as much as possible. So there's one hand right over there, and sorry, so I think you already asked, so I think there's a hand behind you that we'll go. Can we just quickly pass the mic? And if you can keep it as short as possible.
Hello. Can I go?
Yes, sir.
Right. In this rating which we allocate to the mutual funds, one of the factors that is considered is the AUM. So can you please indicate why AUM is important in whatever rating you give to the mutual funds?
No, in our rating system, we don't take into account the AUM. But AUM could be relevant in many categories. AUM could be irrelevant in many categories. Like, I really am reluctant to recommend a small cap fund which has become a 30,000 crore fund. But for a 2 lakh crore fund, I don't mind a large cap fund if it is able to beat the index over time. For a liquid fund, the bigger the better. There are categories where the economies come into play. And there are places, there are segments or kind of funds where big is not good.
Thank you.
Thanks. Can we go at the back? I feel like people at the back don't get enough chances because we can't see. Yeah. Go ahead.
Dhiren, good afternoon.
Good afternoon.
I've been following you for over 2 decades, so it's an absolute honor to be asking you this question live today. Do you think mutual funds are something that can be a comprehensive portfolio planner for an individual today? Or do you think beyond a certain point, let's say somebody whose portfolio is about 5 crores or so, except the special tax treatment vehicles like an employees provident fund or a PPF which enjoy the triple E status, apart from these special tax treatment, do you think something like a PMS or something is like a PMS should be a part of one's portfolio beyond a point?
No, I think, mutual fund could be a complete solution. And only after you cross a threshold. And, with PMS, one has to be very careful. You have to really go about validating it because somebody has the credentials, somebody has a track record, and you can verify it. One thing which you should not really, and there is a specific disadvantage. And so the universe of PMS which you can verify, validate, and make sure that, you like it and you like it for a reason, because that is also a long-term vehicle. It is just another way of investing in equity. You invest directly, invest through a mutual fund, and invest in a PMS. Look at the difference. When you entrust your money to a mutual fund and it remains invested for 20 years, the fund manager, whatever he does, it is not taxed. When you give it to a PMS, it is basic, all the transaction will translate. So if the PMS manager does not have a long-term orientation, it could be disadvantageous. And then you have to really understand that you are buying into that idea. You are really entrusting your money who will add value meaningfully and have the credentials.
Thank you everyone so much. I'm afraid we have to be sticklers for time here. But just want to say once again that Dhiren has an amazing, simple, clear philosophy. And that's one that I also follow. So please do read what he writes very often. And he's one of the few people, as was introduced, the OGs of personal finance in India.